and in this video I'd like to teach you a skill on how to read and evaluate any chart in just a couple of seconds. Because if you look at any chart,
Thank you guys. No sound. Okay, let's try this one more time. You guys can hear me now, right? Let me know if the chat, if you can hear me. Check 1 2, check 1 2. Is the sound coming through? Give me a thumbs up in the chat if you can hear me. Okay, great. 3, 2, 1. What if I told you that most traders are simply losing because they don't understand what they're looking at? You know, if you could look at any chart and instantly know what was happening, wouldn't your trading improve? Yeah, of course it would. But the problem is, most traders start losing money, they get very frustrated, and then they just assume that what they were seeing was random. When in fact, it was actually just something they didn't understand. And I know because I've made that mistake myself. But what if I told you that every single chart you see boils down to just two key patterns: trends and ranges? In this video, I'm going to comment on this 8-second chart decoding trick. And we'll talk about how to identify these two patterns in seconds, how to trade them with confidence, and then how to avoid the biggest mistakes to keep traders stuck. And stick around because at the end, I've got a trading challenge to help you apply what you learn. Let's get into it.
Hello everyone, it's Dale here, and in this video I'd like to teach you a skill on how to read and evaluate any chart in just a couple of seconds. Because if you look at any chart, then it really consists of just three things or three patterns.
Okay, so he's gonna say three patterns, but what I'm gonna show you is how to actually understand this in two patterns, because that third pattern is actually just a variation of the second pattern. So to be clear, my goal with this video is to make this video 10 times more valuable for you so that you're 10 times more likely to actually apply what you learned and see some real results. And the core concept is there's these three market patterns. But like I said, I'm going to help you understand that, so you only have to remember two.
The price is either in a rotation, like for example in here, or the market is trending, like for example in here.
What he calls a rotation, I call a trading range. So understand those are the same thing. Rotation, range, same thing.
Or there is a swift rejection of either higher or lower prices, like for example in here. Those are three patterns that every chart you look at, and it doesn't really matter what time frame or what trading instrument you use, every chart consists just of those three patterns.
Okay, so let's break it down. Three patterns. He's calling them what? Three. Number one, a rotation. Okay. Number two, a trend. And number three, a rejection. Now, my promise to you is how to understand these in two patterns. And here's the key. First, understand that rotations are when the market is balanced. Now, all charts on all time frames, whether you're trading futures, stocks, crypto, Forex, all charts are constantly coming back to the average price. Now, why is that? Because the goal of all markets is to facilitate the maximum amount of trades. And where are the maximum amount of trades as far as price is concerned? Where buyers and sellers both agree that the price is reasonably fair. That's called the average. So that's why the markets are always coming back to the average price. Now, when the market is in that average price kind of zone, what you see is a rotation, or I would consider a range, okay? Call it a rotation, call it a range, doesn't matter, it's the same thing. 80% of the time, the market is in a range because that's the goal of the market. And that's when buyers and sellers are trading the most. Next, you have a trend. And 20% of the time, one side dominates the market. That's when the bulls come in and they say, step aside, bears. We have the conviction, and they send the market racing up. Or the opposite, right? The bears dominate the bulls and they send the price down, okay? That's called a trend. One-sided trading, okay? Now, the third is a rejection, and we'll talk about that next.
Nothing else. And if you learn how to recognize this, then it will give you a huge edge in your trading. So let's go over a couple of patterns here.
Now, before we go any further, pop quiz. My goal is to be here to help you get some breakthrough results in your trading, okay? Not just for your entertainment. So show me you came to here to learn something, and post in the comments right now, what are the 3 patterns that he's sharing in this video? What are the 3 patterns that he's sharing in this video? I want you to list them out. 1, 2, 3. We just covered it.
Let me do little drawings here. So right here, there's a rejection of higher prices, right? So that's the rejection. We also have a rejection in here, and also smaller rejection in here and smaller rejection in here. Now let me highlight the rotations. Rotation is in here.
You can think of a range or rotation as a rectangle. It's literally a rectangle, okay? And the rectangle is where that price stays within. That's the range, okay? So think rotation, also range, also rectangle.
And there's a rotation in here. Also a little rotation within this trend and rotation in here. Also I missed this one, and that should be about it. Now what remains are the trends. So we have a trend here, 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 in here, and in here. And as you can see at this point, we named each part of the chart, and we needed just 3 patterns: rotation, trend, and rejection. So this is how, if you look at any chart, this is how you can break it down to those very easy to see patterns. Now some of them appear very often, some of them are rare. If we talk about rotations, like for example in here, then rotations appear 70 to 80% of all the time. If you look at any time frame, any trading instrument, then it will really be like this. 70 or 80% of all the time of all the charts, they'll be in a rotation, right? The rest is the trend, which is like a 20 to 30% of the time. And the most rare of them all are the rejections, which are very rare and happen just now and then. And they don't really take up that much time. Now every one of these patterns have some meaning. When there's a rotation, which is most common, then the price is telling us that the market is in equilibrium.
That's exactly what we just said, right? Equilibrium means the buyers and the sellers agree that the price is reasonably fair. And so they're trading back and forth. Buyers and sellers trading, buyers and sellers trading. And there's the most transactions facilitated at that price. So I also said that I was going to promise you how to actually turn these 3 patterns into just 2 patterns. And the way that you do that is by understanding that a rejection, what he calls a rejection, is actually just a rotation, okay? And if you think about that, yeah, a rejection is exactly a rotation. The buyers were in control here. They shot the price up, and then the sellers came back and they took over control. So this is actually a rotation as well, or a range. And if you were to draw a box around this, you could see that by seeing that we went all the way up here and then all the way down here. And so that's another variation. A rotation and a rejection are basically the same pattern.
That means that the sellers and buyers found a fair price, right? This is the area with a fair price. Both buyers and sellers are content with the price being in here, and they are content with the buying and selling in this area.
And you have to think a little bit carefully here, okay? But this is essentially the same as this. We could draw a rectangle box. It would be more like a square around this area here. Okay, so from down here to up here, you could see that we went down and we went up and we went down and we went up and we went down. So that's another variation. And if you were to switch time frames, you would be able to see it very clearly. If you took if you marked this out and made this, noted on your chart, you could actually zoom in. Let's say this is okay, so this is a 30-minute time frame. If we went to like a 2-minute time frame or a 1-minute time frame, this price action in here would actually look a lot like this.
At least for the time being. Now, another thing that is important to note about rotations is that in rotations, heavy volumes are very, very often traded. Let me show you with the volume profile. Volume profile shows us the volumes, and the wider the volume profile is, the heavier volumes are traded in that zone which I selected with the volume profile. As you can see, in rotations, the heavy volumes are often the heaviest, right? Also, for example, in here. And the reason is that the big trading institutions are very often accumulating their trading positions.
And another word for rotation or trading range is consolidation, okay? Because that's literally what's happening. The price is consolidating in an area. And as you can see with this volume profile, do you see how it's got this huge spike here, which means the amount of transactions here is peaking, which is what we've been saying.
In other words, they're entering their trading positions there. And the reason why they do it in rotations is that in a rotation, they can do that. They can accumulate their trading positions without being noticed. And those guys have simply huge trading capital, which they need to allocate. And for that reason, they need time. So they do it in a rotation where they are unnoticed and also where they have liquidity, right? Because there's equilibrium, there's enough buyers and enough sellers. So that's why in rotations, heavy volumes are often traded. And remember this, because this is a very, very important thing. Now,
like we said, it's on every time frame, every chart. This is what you're going to see. Now, why does this matter? It matters because when you recognize these patterns, it will instantly help a trader enter at the right time and avoid bad trades. Just by being able to identify these patterns more clearly, you'll be able to avoid a lot of bad trades, which is a great thing. Obviously, making more money instead of less money, right?
Another important thing here is that the longer the rotation, then usually the stronger the trend that comes after the rotation, right? So the longer the rotation, the longer it is, the stronger and longer the trend. So keep that in mind, because this is also a pretty important piece of information. Now, talking about the trends. Trends don't occur as often as the rotations, and what they are telling us is that one side of the market is way more aggressive than the other one. In here, it's sellers. Sellers in this downtrend are way more aggressive than the buyers, and that's why the price goes steeply downwards, right? Sellers are aggressively pushing the price downwards, and they are doing so with market sell orders. Now, what remains is the rejection.
Now, I want to say one more thing about ranges, okay? Ranges or consolidation. When the market is ranging, and as he said, the longer it's ranging and going sideways, okay, the bigger opportunity there is for a breakout into a trend, okay? And you'll see that, right? Like this went sideways, 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 and then you got a pretty decent sized trend. That's a pretty big move down there, okay? So notice that the longer that it stays boxed in that range, the greater opportunity often comes after that. But I want you to understand what's happening here, because as we said, this is happening 80% of the time. 8 out of 10 times you look at any chart, this is what's going to be happening. It's going to be in one of these ranges or these consolidation phases, okay? And I want to explain this to you through an exercise. So imagine there's a group of runners. Imagine there's a group of runners starting on that starting line of a race and they're crouched down, okay? And they're waiting for the sound of that gun to go off. Just think of that and understand that everyone knows that a sudden burst of speed is coming, but no one knows when it's going to happen and which runner is going to take the lead. You guys with me? Okay. Now, this is exactly what's happening when the price is in a consolidation zone or a trading range. And then when the gun goes off, whether it's a break up or a breakout down, the price quickly surges in a direction, creating a powerful trend. You guys got it? Okay, so that's what's happening when the price is doing something like this. So that's where the opportunity is increasing, and you want to be able to identify those, because when you see that breakout happen above or below, that's when the opportunity spikes.
For example, this one. This is a pretty strong rejection of higher prices. And in here, in this example, this is telling us that buyers were pushing the price upwards aggressively, and then sellers started to jump in and pushed the price downwards. Right? So this is a strong rejection, and it marks a very, very important point in the market, because this is a place which was defended, right? This is the place which was defended, and it was defended very aggressively here, right? So this is definitely an important place for all market participants. Everyone who's trading this chart right now knows about this rejection, and they're making their trading decisions around it, right? And that's why this also could work as a strong resistance zone in the future.
Okay, another way of explaining this is price. Think of this as price, okay? So the price is here and the price is going up. Now, when you're going to buy something, if you're interested in buying and the price goes up, are you more likely or less likely to buy? If you're interested in buying something and the price goes up, are you more likely or less likely to buy if the price goes up? Obviously, you're less likely. So what happened here, okay, and this is a easier way of understanding this. This is how I would explain this, is that the price got too high, okay? There were buyers here and there were buyers here. A green candle closing means there were more buyers than sellers. And that happened here, 2 in a row, and then it happened here. Look how big this candle is. That means there was a F ton. An F ton. You guys know what I mean? An F ton of buyers, okay? But then what happened? We went even higher, but then immediately the price reversed down, okay? So the price got so high that all the buyers stepped aside and they say, no, that's way too high. And then what happens when that happens is that the sellers come in and immediately they see an opportunity, because suddenly the buyers stepped aside. Because if there are more sellers, then we're going to send the price down. And that's exactly what happened here, okay? So when you get to these extremes, this was the extreme, and then here we went above the extreme. Now, this is a resistance zone. That's why it's called a resistance zone, because you're going to move into some resistance. It's like resistance in your life. You know, when the alarm goes off and you're like, I don't want to get up, that's a resistance zone, okay? So that's here. This is like your alarm clock zone, okay? Think of it like that. And what happens is the price resists. And usually what'll happen is that the opposite side will come in and then they will try and take control. And that's exactly what happened here. Okay, so I want to make sure you guys are following. We've got rotations or ranges. We've got trends, and we've got rejections. Okay, we just covered rejections. And rejections, as I said, and here's your second pop quiz question. So I want you to post the answer in the comments right now. Show me you came to learn something and not just be entertained. What is it, a variation of a trend or a variation of a range or a rotation? Post it in the comments right now.
Now, what I would like to do is give you a couple of more examples of those 3 patterns, so it is a bit more easier for you to identify them. So let's move the chart a bit. By the way, I haven't mentioned this. We are looking at euro dollar 30-minute chart, and sometimes there are more ways how you can look at it actually. Like in this case, for example, you can look at the big picture and say that, for example, this was a huge downtrend, right? Or you can break it down into smaller pieces and say that that was a rotation, 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 and downtrend, downtrend, downtrend. Both ways are correct. It only depends of how detailed you want to be with this. Now, as I was saying, you can do this with any time frame and any trading instrument. So let me switch over to the ES. This is 5-minute chart of the ES. On the faster time frames, those are sometimes a bit more volatile. The mood is changing a bit faster because it's fast time frame. So in those cases, sometimes it's harder to identify those patterns because they change a little bit too often. But you can still do it here. It only is sometimes a bit more difficult. So if you look here, then we can look at this part as a...
Now, what is this? Pop quiz. Okay, pop quiz. We are, a good ways into this video, okay? So you should already be starting to be able to recognize these faster. Okay, and that's my goal for you in this video. Not only that you come here and you learn something, but that you go out and apply it so that you could get some results, okay? So tell me right now, look at the chart, okay? Look at the chart. Just take a few seconds. Take 8 seconds, okay? Because remember, this is the 8-second chart decoding trick. And tell me, what pattern is this, okay? What pattern is this inside the black box? Put in the chat right now. I'm going to wait a few seconds for your answer. I want you to look at this pattern right now and tell me which pattern this is, all right? Put your answer in the chat right now, okay? There's only 3 options, okay? There's only 3 options. We covered 3 different patterns in this video so far. So, all right. And my man Craig, he got it right. That's the correct answer. It is a range or a rotation. Nice work. And I said also, you could call it a rectangle, right? Because that's exactly how you mark it out.
Rotation. Then there was also a huge rotation in here. And the rest were trends and rejections. So those were trends and those were rejections. And now the market is trending here. Let me do one more example. Let's go to chart of gold. This is a daily chart. And as you can see, it is way easier to read. It's way more calmer because the market sentiment doesn't change that quick as with the fast time frame. In here, we see a very, very long rotation. Before that, and after that, a trend. And before this trend, there was also a rotation.
All right, so you can see it, right? We've got the ranges or the rotations marked out with black, and we've got the trends marked out in blue.
All right, so with the higher time frames, it's usually easier to read this and recognize those patterns. Now let's go to the next very important point of this video, and the thing is why this is helpful. How can you use this in your trading? What you can do, and what I do as well, is you can build your trading strategy around those 3 patterns. For example, when the market is rotating, you can trade from the extremes of the rotation.
And that's exactly what is the right thing to do, because that's how you make money when the market's doing this. Now, when he says trade at the extremes, what does he mean? Okay, what does he mean when he says trade at the extremes? And what he means is BLSH. Okay, put that in the comments right now, BLSH. Now, what does BLSH mean? Pop quiz, 3, 2, 1. It means buy low, sell high. So when you see a range or a rectangle or a rotation, we're going to buy low and sell high. So how do we do that? Well, we're going to buy at the bottom third of the chart. Here's an easy way to do this. Mark out the chart in thirds, okay? And I'll show you how to do this in trading range. Let's look for a trading range on the chart right now, okay? Look, here is a trading range. Like we said, 80% of the time, 8 out of 10 times when you look at a chart, you're going to see a range, okay? So here we go. You don't have to look very far. So here it is, right? Here it is on my chart. Now there's that range. You guys see that rectangle? So here's the way to do this. You mark the price out in thirds, okay? So we'll mark it out in thirds. So first, let's Let's draw a box and we'll mark this out just so we have the rectangle, okay? So now we've got the rectangle and I'm gonna make this white, but I'm gonna give it a big border, okay? And let's make it nice and thick, okay? So you guys see that there? All right, cool. So then what we'll do is we'll divide this. We'll just divide it into 3 pieces, okay? And here's one way to do it that's pretty simple. You just mark it in half, okay? And you know that the middle is going to be about halfway in between those two, okay? So there's your thirds, right? Boom, okay? So where are our buy entries? Our buy entries are going to be in the bottom third. So here are buy entries, and we'll mark those green for buy, okay? And then where are our sell entries? We're going to mark those red for sell. So there they are, okay? So can you see now why you would want to do this? Because that's where the opportunity is the highest, right? Think about it. If you sold here and you bought here, okay? If all you did was just wait for the price to come into this buy zone or this sell zone, and all you did was buy in the buy zone and sell in the sell zone, that's how you'd make the maximum amount of money. You guys see that? Okay, cool. Let's keep going.
Toward the center of the rotation. That means, in this case, shorts from the higher border of the rotation, longs from the bottom border of the rotation, and the ideal take profit would be the center.
Okay, now he's saying take profit in the center. That's an alternative, right? You can also take profit in the center if you want. It's up to you, your choice. But you'll make more money if you buy zone, sell zone it. So up to you, both good options.
Of the rotation. So when you identify a rotation, you can trade like this. But what you also need to do is you need to keep in mind that after a rotation, there will be a trend. So the longer the rotation, the more vigilant you should be, and you should expect a trend, like here. And when the market starts trending, you need to apply another trading strategy. It could be breakout. A lot of people trade breakouts. Or what I prefer to do is I prefer to jump in that trend when the market makes a pullback, right? So for example, here's a pullback, and this is the place from which you go long.
And we talked about this yesterday. That's also called a dip buy, right? Buying the dip. Why? Because the price is breaking out. You wait for it to dip, and then you buy that dip for a move up.
Another pullback, another possibility for a long trade, right? Wait for those pullbacks where the market gives you a little discount and jump in that trade and ride the trend.
And you ride that trend like a surfer riding a wave, okay? Now let me show you guys some more examples from my own charts, okay? So here's an example, and listen, you got to collect your own charts, right? So what you should be doing is you should be looking at charts, taking screenshots, and then using something like Google Sheets to collect them so that you can continue to train your eyes to recognize these patterns over and over again, okay? So what we're talking about now in this video is waiting for the price to break out of a range or a rotation, right? So notice I've got the range marked in yellow. Now I marked the range in yellow, and this is an actual trade that I took. I marked the range in yellow because it is neutral, right? You've got buyers and sellers trading back and forth, okay? And what I'm looking for, this is on the open, okay? I'm looking for the price to break out either above or below. And ideally, what I want is something like this, where I have bullish context, because the market opened and we had a strong bull breakout to the upside. And then we went sideways into this consolidation zone, rotation, or range, right? Doesn't this look like this? Okay. So this is what I'm saying. You've got these patterns happening on all charts on all time frames. So what I want to happen when I see this, if the context is bullish, meaning to the left there was strong buying, I would ideally like to buy because then I have the trend on my side. So I'm looking for confirmation of a breakout. And when I see 1, 2, 3 consecutive bull bars with the second bull bar bigger than the first, and the third bull bar bigger than the second, that is a sign of accelerating momentum, which tells me that if I buy here, that successful breakout, that breakout rather is likely to be successful. And so that's why I bought here. And you can see I've got my stop loss below this entry candle. If you zoom in on this, you can see 26. I've got it marked. Okay. So candle, 25 I bought here. And then I put my stop loss here and I got out at a multiple of 1 risk to reward. Okay. So buying here, selling here. So that's a good trade. And all we're doing is applying exactly what we're teaching you in this video from this chart decoding trick. Noticing that this is a consolidation or a trading range, right? And then waiting for the price to show signs of a successful breakout and then getting in and riding that trend, okay? Let's look at some other examples from my charts. Here's another example from my charts. Now, what you see here, okay, is the rejection. Okay, so what he was talking about and what we pointed out to you and we said was the alarm clock zone, you know, that resistance zone is when we get to those extremes and the price rejects down. So notice the extreme was over here, right? And we got all the way up to that area right in here. Okay, and then we rejected down. Okay, so a short trade here would be very similar in the sense that I've got a bear bar here, and then the second bear bar, it's going to be red on your chart most likely. On mine, they're black. And the second one's bigger than the first one, right? So that's showing rejection into this resistance area, and then a strong bear breakout to the downside, showing you an entry here or here. You could possibly wait for that second bear bar to close and then enter there, and then taking profits down here. Okay, you can take profits at that. Well, it's up to you where you take profits, but one option is taking profits when we get back to that moving average, which is the blue line, okay? So here's an example of a breakout entry, and here's an example of a rejection entry, okay? Now let's look at one more example of a consolidation or trading range breakout, okay? So here we have a consolidation zone or a trading range, right? Notice that we went up and then we went down, and then we went up. Okay, so the trading range is right in here, right? And then we're breaking out above that trading range and we're getting long as soon as we're breaking out, showing a strong sign of a breakout, which would be this candle closing on its high, this bull bar closing on its high. Your entry's right around here, okay? So you've got 1, 2, 3, 4 consecutive bull bars showing strong momentum to the upside. So there's your long entry, okay? And it's also breaking out above that consolidation zone or that range, okay? So you got some examples from me. You got some examples from him. Now look at your charting platform and try and find some examples for you. And what I want you to do as you follow along in this video, okay, and I showed you my examples, right? I'm going to give you a 3-step action plan, which is to pull up TradingView for yourself and to identify and see how the price moves after each of these patterns, okay? And then once you do that, I've got a challenge for you, which is to post your marked up chart in the Trades by Bren community, okay? And then you'll get feedback on whether or not you're able to identify these patterns successfully or not. And the way you do that, by the way, is you just go to the Trades by Bren YouTube channel and click on post or community.
Same time, keeping in mind that the longer the rotation before the trend, the bigger probability that the trend will be strong and that it will be longer. Now what remains is the rejection. Let's go back to the ES, for example, and when you see a rejection like this one, this is a strong rejection of lower prices, then this tells you that this was an important zone in the past, that strong buyers were defending this zone. Right? So this whole zone was a support and strong buyers were defending it.
Now, guys, remember I showed you a resistance zone at the top of the chart. And I said that was like the alarm clock zone. It's when the resistance comes up, right? Okay, this is the same thing, but to the downside. And we call that a support zone. Same idea. Okay, same idea, just the opposite direction.
So it is also likely that when the price comes back to this support zone, there will be a reaction from there. It could either bounce off that support, which could give you a nice trading opportunity to go long from the support, or another scenario is it shoots past the support, and this would give you an information that sellers are very, very strong and determined that they were able to push through this strong support. And what you can do with this kind of information is that you know that sellers are strong, so you want to join the winning party and you want to start trading shorts because you got a clear signal that sellers are dominating the market and that they pushed through a very strong support. So those are the 3 patterns which you can use to read any charts in just a couple of seconds. It is very useful skill to develop. At first, identifying those patterns could take some time and it will take some practice before you perfect it, but it is not really too difficult, and I highly recommend learning how to recognize those patterns and use them.
Absolutely. Okay, strongly recommended. So next, we're going to fix some common mistakes. So what are some common mistakes that you could make when you're trying to identify these patterns? You know, one of them is confusing a rotation or a range with the trend. So how do you tell the difference? Well, one of the easiest ways to tell the difference is to just draw on your chart, right? Notice we just looked and we just drew some boxes. Okay, and just that simple act of using the rectangle drawing tool helps us identify them. Notice what I did is first I used the brush tool, okay? And here's another one, right? I use the brush tool and I go, okay, that looks like a trading range, okay? And I call it a trading range. I don't like calling it a rotation, okay? Because that's more self-descriptive. It's a range, right? It's stuck in a range, okay? So first I identify with the brush tool. And then what I'll do is I'll draw a box, right? So now we've got that range marked out. And then, like I said, I like to mark them in yellow because to me, yellow means neutral. And then what you can do is just wait for a breakout above or below. So that's an easy option and a way to avoid those mistakes by actually drawing on the chart instead of expecting your eyes to see them without any help, okay? Now, another mistake that you could make is entering too early on rejections, right? And you could also think that a breakout is going to be successful, but that breakout fails. And we call that a false signal, okay? So what you want to do is use the breakout rule. And what that means is if you think the market's long here, and if you think we're going to break out to the upside, which is reasonable because look, this blue line is the average price. And notice that this, oops. Okay. Sorry about that. So you can draw on your chart and you can see there's a trading range right here. Okay. So I marked this out just by drawing a box, right? And then I can think that the likelihood is that we're going to break out to the upside because this blue line is the average price. And what do I notice about the moving average? We're above the moving average, right? The price is trying to break below that blue line, but look at what happens every time we touch it. We touch it and we bounce off it. We touch it and we bounce off it. We touch it and we bounce off it. And it is doing that all in here, right? Look, 1, 2, 3, 4, 5, 6 times. So that's showing strong support from the bulls. And that shows us that a breakout to the upside is possible. However, we don't want to just assume that the breakout to the upside is going to happen. So what you need to do, and this is the breakout rule. The breakout rule is we don't have a breakout until you see confirmation. We don't have a breakout until you see confirmation. And we didn't see confirmation until this candle right here. Okay? So if you wanted to trade this, what you could do is actually switch to a shorter time frame. And as the price was moving up, get in on a shorter time frame on one of those bull closes and get your profits. Take quick profits on that. And that would be a way to trade that. Or you could actually just hold that trade and deal with the pullback and try and get out somewhere up here or up here. It depends on your style. If you're scalping or swinging, that's 100% up to you. Okay. So we've got some tools there to avoid entering too early, and that is waiting for confirmation. How do you avoid entering too early? Wait for confirmation. What's confirmation? If you're long, confirmation is a bull bar closing past its midpoint. What's confirmation if you're short? A bear bar closing past its midpoint. Now, another major mistake that you could make with this is ignoring macroeconomics or big market moving news. Whenever the Fed, the US Fed, announces anything about interest rates, the market moves huge, usually, okay? So how do you avoid this mistake? You just use Financial Juice. You go to Financial Juice, which is a reporting website, and it'll tell you if there's any major economic news. And then you can avoid this by making sure that you do not start your trading session unless you go to financial juice first. Okay. So play this game with yourself to test yourself and apply what you learned in this video. Pause and guess: rotation, trend, or rejection. And as we said, I call this a range, a trend. Excuse me. I call this a range, a trend, or rejection. Okay. So that's the game. And what you can do is test yourself and just sort through different charts and just pull up different charts and quiz yourself. Look at what you like to trade. Then look at things you don't trade, right? Like let's pull up Bitcoin. Okay. Let's see if we can do it with Bitcoin. Let's use a 4-hour chart. Okay. Well, what I see here is I see a range. That's what I see here, right? I see a range there. Okay. And then what I see here is I see a rejection, right? And this is very much like what we talked about. This here is that support zone. You see that? So we'd mark that in green. And notice exactly what he just said in the video. We came down to this area and we bounced out of it. And when it comes into this area, one of two things is going to happen. We're either going to bounce out of that area, essentially buyers, where there was buyers before, or we're going to break out to the downside and go down. So you want to watch when we move into these areas and look for a rejection, because that's where the opportunity is going to be the highest. If you entered long here after this bull close, your risk would be relatively small and you would be able to get a decent profit target on that trade, right? If the trade would look like this, right? You could put your stop loss a couple ticks below that bull close, and you could go for, say 1 times your risk. This is 1 times your risk. You could go for 1.5 times your risk, right? And there you go. Let's see if we got 2 times risk. Yep, you can even make 2 times risk on that. Now, what does that show you? It shows you that that's what institutions are doing. The smart money is doing that, right? Smart money, every trader likes 2 times their risk, right? So look, we went almost to the tick 2 times the distance between that bull close if your stop loss is there. So that's how you can tell that what I'm telling you is true, because that's what institutions are doing. And this is not stuff that I made up or anyone made up. These are observations that traders have made over years of watching these patterns, okay? So here's an exercise I want to give you, because my goal in this video is to get you to apply what you learn. Apply what you learn so that you can have a radical transformation in your trading results. So here's the exercise I want to give you called the Edge Builder. Here's the Edge Builder process. What you're going to do is 3 things. Number 1, you're going to track these patterns and you're going to see that they lead to better probability and stronger execution. So notice when you trade these patterns, what happens to the probability, which would be the accuracy of the pattern, and what happens with your execution, right? What you'll start to see is that it starts to improve your confidence, because these are reliable patterns as long as you apply them well. The second thing you're going to do is you're going to notice which patterns lead to the best risk reward setups. Now, I just did that with you right here, right? Notice a 1 to 2 risk to reward ratio is great. Just ask yourself, if you could spend $1 and with the possibility of making 2, how often would you do that? Answer: as often as possible, right? If you told me that you would give me $100, if you told me that you'd give me $200 every time I give you 100, so I give you 100, you give me back 200, I do that all day long, okay? So that's a really good risk to reward on rejections, right? So rejections are a really good entry, and you're going to do your own research and notice which patterns lead to the best risk reward for you, okay? Next thing is you're going to develop a repeatable process for high probability trades. So there's your exercise. We call it the Edge Builder, and I want you to apply that. And this is your call to action. I want you to try this right now, mark up your charts, and just mark up all the trading ranges and the trends, okay? All the trading ranges and the trends. And for bonus, mark up the rejections, okay? And post that to the Trades by Brent community tab. As I showed you, it's right here. You just click post, or it'll say community, and you will get feedback from other traders, including myself, on that. And I want you to comment below, okay? Everyone watching this video right now, go to the comments below and tell me, what do you find is the hardest part of spotting these patterns in real time? Now listen to the question. In real time, okay? I don't care how easy or hard it is for you to spot these patterns after they've already formed. What I'm asking you about is, what's the hardest part of spotting these patterns in real time? Post that in the comments right now. Now, if you're curious about my strategy, if you want to see some ideas about how I trade, I've got a free downloadable PDF for you called My 3 Favorite Setups. And in that document, I will share with you the 3 patterns that I look for, how I set my stop loss so I can control my risk, and how I take my profit targets so I can get out before it's too late. If you want to download that, I've got it for you for free at tradesbybren.com. Hit the like button if you like this video, and subscribe if you want more. And if you're curious about the tools I'm using, one of them is Trading Range. This is my favorite one right here. Okay, I've got the tools that I'm using, including the charting platform I use, which is TradingView, like I said, and then also the prop firm that I'm trading with on a funded account. Hit the link in the description for those if you're curious about that, and you can try using some of my recommended tools. Thank you so much for watching, and I'll see you next time.